Ever look at one of those dense company earnings reports, full of jargon, and just wish someone could cut to the chase, tell you what really matters? Well, that's exactly what we're doing today. We're digging into C3.ai Inc. That's C3.ai, focusing on their pretty dramatic Q1 fiscal year 2026 earnings. Okay, let's unpack this. Our goal here is simple. Give you the shortcut. Make you genuinely well-informed about C3.ai's recent performance without you having to wade through everything yourself. We've pulled their official numbers, mixed in what the market's saying in real time, and we'll guide you through it all. We use a five-part structure to pull out the key insights, those aha moments for you.
That's right, because looking at quarterly earnings numbers in a vacuum, it doesn't tell you much. You really need context. What was expected? How does it compare to their own past promises? So this deep dive, it's about helping you understand not just the numbers themselves, but what they actually mean for C3.ai and, where things might be headed.
Exactly. Let's jump right in. We'll begin with now for slide 1, the at-a-glance scorecard. This gives us that first crucial impression. And, well, that first impression. It's pretty stark, honestly. This wasn't just a minor miss. It feels like a really significant, worrying departure from their old growth story. We're seeing a sharp drop in revenue and, maybe more concerning, losses are getting much bigger. They fell way, way short of the guidance they originally gave.
Yeah, that original guidance piece is key. And remember, things look so bad that they actually put out a preliminary warning back in August that basically reset everyone's expectations way lower.
Ah, right. The preliminary warning. So how did they do against those lower expectations?
Well, it's kind of mixed, but only against that lowered bar. They reported revenue of $70.3 million, which just missed the revised consensus estimate of $70.34 million. So basically flat there. But on non-GAAP earnings per share, or EPS, they reported a loss of 37 cents. That was actually a tiny bit better than the revised forecast, which is for a 38-cent loss.
Okay, so a slight beat on the revised EPS, but still missed revenue slightly.
Exactly. But, and this is the big but, you absolutely cannot forget the huge miss compared to their original guidance from back in May.
Yeah.
They were talking $100 to $109 million in revenue then, getting only $70.3 million. That gap is just massive. And that's really what spooked the market.
And you could certainly see that spooked reaction in the market. The stock price, it took a big hit, dropped about 10.5% after hours on September 3rd, down to around $14.93. And like you said, this was on top of earlier drops after that preliminary warning. Analyst sentiment, overwhelmingly negative. I mean, you saw terms like completely unacceptable.
You really don't hear that every day.
No, you don't. The focus was definitely on the revenue miss, yeah, but also deep concerns about how the company's being run, especially this internal reorganization they did, which seems to have caused a lot of disruption. Let's put some hard numbers on it. Comparing this quarter, Q1 FY 2026, to the same time last year, Q1 FY 2025, total revenue. $70.3 million this year versus $87.2 million last year. That's down 19.4% year over year. Net loss. This ballooned to $116.8 million from $62.8 million. That's an 86% bigger loss. A huge change. And diluted EPS followed suit, a loss of $2.86 this quarter compared to 50 cents last year. So the loss per share grew by 72%.
So, okay, the big question, what does this all mean? Why did the loss grow so much faster than the revenue fell? This is where we see that severe negative operating leverage kicking in.
Negative operating leverage. Explain that again.
Yeah, think of it like this. Your sales drop by, say, $1, but your profits drop by $4 or $5.
Yeah.
It's when costs don't scale down with revenue, or worse, they actually go up. Here, a 19.4% revenue drop led to an 86% jump in net loss. That massive amplification. It happened for two main reasons.
Okay, what are they?
Reason one, profitability per sale just collapsed. Their GAAP gross profit, the money left after the direct costs of making the sale, fell by almost half, 49.3%, from $52.2 million down to $26.4 million. That's way faster than the revenue decline. It means their gross margin got squeezed really hard. They kept much less of each dollar that came in.
Got it. And the second reason?
Reason two, operating expenses went the wrong way. While revenue was falling, total operating expenses actually grew by 21.3% year over year. Jumped from about $125 million to over $151 million. So you've got plummeting gross profit and rising operating costs hitting at the same time. That's the pincer effect we mentioned. It just crushes the bottom line.
Pincer effect. Yeah, I can visualize that. Squeeze from both ends.
Exactly. And just a quick note on that diluted EPS for a loss-making company, it stays the same as basic EPS. Including potential shares like options would actually make the loss per share look smaller, which is anti-dilutive, so they don't do that.
Okay, that clarifies the EPS figure. That pincer effect really paints a picture of a business struggling structurally. Let's dig deeper into why those losses blew up. We need to look at the core profitability engine, or lack thereof. Let's move on. Moving to slide 2, the engine of profitability. As you said, this quarter feels like a real double whammy. Margins shrinking, costs climbing. It points to, well, structural unprofitability, doesn't it?
It really does. Let's break down that gross margin collapse. The GAAP gross margin fell off a cliff, down to 38% from 60% last year. That meant GAAP gross profit tumbled from $52.2 million to just $26.4 million.
38% margin. That's quite low for software typically.
It is. And even the non-GAAP gross margin, which
Wow.
smooths out things like stock compensation, also fell sharply, down to 52% from 70% last year. Non-GAAP gross profit dropped from $60.9 million to $36.3 million.
But even the adjusted picture looks bad. Why did margins fall so much?
Well, this is really telling. The cost of delivering their subscription revenue actually went up by almost 25% year over year.
Up, even though subscription revenue fell.
Exactly. Subscription revenue fell 18%, but the cost to deliver it rose 24.6%. That suggests some serious underlying problems. Maybe they've lost pricing power, maybe cloud hosting costs are out of control, or maybe they're just becoming less efficient at delivering their services, spending more to deliver less.
Wow. Okay, so making less profit per sale, and then you layer on top what we're calling runaway operating expenses. Costs went up even as revenue dropped.
That's the other side of the pincer. Costs increased across the board. Sales and marketing, for example, up nearly 20% to $62.5 million.
Spending 20% more on S&M to get 19% less revenue. That math doesn't work.
Not at all. It screams inefficiency. And it really backs up what management said about that sales reorganization being disruptive. They were spending more, but closing fewer deals, apparently.
What about other costs?
Research and development, R&D, also climbed 22.2% to $64.7 million. That puts huge pressure on the bottom line when revenue isn't growing. And general administrative, G&A, grew 22.3% to $24.1 million.
So costs up everywhere.
Pretty much. And what's fascinating, or maybe alarming, is seeing both things happen at once. Gross margin collapsing while operating expenses are surging. It just guaranteed that massive increase in the operating loss. It's unsustainable.
It sounds it. Now, you mentioned GAAP versus non-GAAP earlier. Can you quickly bridge that gap for us again, the headline loss versus the adjusted one?
Sure. So the official GAAP net loss was that big $116.8 million figure. The non-GAAP net loss, which management prefers to highlight, was $49.8 million. The main difference, the big adjustment, is about $65 million for stock-based compensation, plus a couple million in related payroll taxes.
And remind us, stock-based comp is non-cash, but...
But it's still a real cost to shareholders. Absolutely. It represents dilution. More shares get created, so each existing share owns a slightly smaller piece of the company. You, as a shareholder, see your slice shrink.
Right. Dilution is definitely a cost. Okay, so we've seen the grim financial picture. Let's look at where that revenue actually comes from, or perhaps where it didn't come from this quarter. Let's examine slide 3, the engine room business segment performance. It sounds like the weakness wasn't just in one spot. It was pretty broad-based. But that core subscription business declining, that's got to be the biggest worry, right?
Absolutely. Let's look at the revenue stream breakdown. Subscription revenue, that's the recurring high-value stuff for a software company. It fell almost 18%, down to $60.3 million from $73.5 million last year. And remember, subscriptions make up 86% of their total revenue, so an 18% drop there. That's a major red flag. It points to real struggles in winning new customers, keeping the ones they have, or selling more to them.
Okay, that's the core business. What about the other part?
Professional services revenue, that's more like consulting and implementation work. It also fell, actually, by a larger percentage, down 27.6% to $10.0 million.
Yeah.
But while that percentage drop is bigger, services are typically lower margin and less predictable anyway. So the subscription decline is definitely the more strategically worrying trend here.
Got it. So the main engine sputtered. Despite all this, the company did point to some potential bright spots, some business and sector highlights. What were those?
Yeah, they tried to find some positives. They highlighted their federal business, saying they closed 12 deals with U.S. defense and intelligence agencies that apparently made up 28% of their total bookings for the quarter.
Bookings, not revenue.
All right. And they also talked up their partner ecosystem. So they closed 40 deals through partners, and the value of deals in their joint pipeline with partners was up 54% year over year.
Okay, so federal deals, partner deals. Sounds promising on the surface? But like you said, those are bookings. Why isn't that showing up in the actual revenue numbers yet?
Well, that gets to this critical bookings versus revenue disconnect. Bookings are forward-looking, their contracts signed, promises of future business. Revenue is backward-looking. It's when you actually deliver the service and get to recognize the income.
Ah, so there's a lag.
Potentially a significant lag. Seeing decent bookings alongside falling revenue creates a real show-me situation for investors. It means, okay, you sign the deals, now prove you can actually deliver and turn them into real dollars efficiently. Closing that gap between bookings and revenue, that's going to be a huge test for the new leadership. Right now, it looks like potential that isn't quite hitting the bottom line.
Show me indeed. Potential doesn't pay the bills right now.
Okay, let's shift gears slightly. Given all this operational stress, how strong are their finances overall? Let's look at their foundation. Now, on to slide 4. Financial strength and shareholder rewards. In a quarter like this, that balance sheet becomes absolutely critical, doesn't it? It's like their financial safety net. It really is. And the good news here is their balance sheet health is quite strong. They finished the quarter with a very healthy $711.9 million in cash equivalents, and marketable securities. That's a lot of cash.
Any debt?
No significant long-term debt. Their total assets are almost $1 billion, $968.7 million, against only about $170 million in total liabilities. So, for you listening, that strong net cash position, it's paramount right now. It gives them breathing room. Flexibility to fund the operations, fund the restructuring, without having to rush out and raise more money when their stock price is weak, which would be very dilutive. That cash buys them time.
Okay, so time is on their side, thanks to the cash pile. But what about the actual cash coming in, or more accurately, going out from operations? The cash flow and cash burn picture isn't as rosy, is it?
No, definitely not. This is where the concern shifts back. Operating cash flow was negative $33.5 million. They used $33.5 million from operations this quarter.
And that's a big change from last year.
A huge reversal. Last year, in Q1, operations actually generated $8 million in cash. So a big swing in the wrong direction. And free cash flow, which accounts for capital expenditures, was negative $34.3 million, compared to positive $7.1 million last year.
So they're burning cash.
They are. This cash burn essentially means the day-to-day business isn't paying for itself right now. If you annualize that quarterly burn, it's close to $140 million a year. Now, with over $700 million in cash, they can sustain that for several years. Sure, that's the buffer. But turning this cash flow negative trend around, that's going to be the key indicator of whether this turnaround plan is actually working. It's a clock ticking in the background.
A ticking clock, even with the big buffer.
Okay.
And with cash going out, it's no surprise what we see regarding shareholder rewards and dilution. No rewards, just dilution.
Pretty much. No dividends being paid, no share buybacks happening. Instead, the number of shares outstanding is growing. The weighted average share count went up by 8.3% compared to last year, from 125 million to about 135 million shares.
And that's mostly from stock compensation.
Primarily, yes, issuing stock to employees. And again, for you as an existing shareholder, that means your piece of the pie is getting smaller. Each share represents a slightly lower percentage of ownership in the company.
So shareholders are feeling the pain from the stock price drop and from dilution. It really sets the stage for the future. What is the path forward? Finally, slide 5, the road ahead management's outlook and key takeaways. Expert, it feels like the whole story around C3.ai has just been rewritten this quarter. It's gone from high growth potential to, frankly, crisis management and turnaround. The focus shifts entirely to the new leadership now, right?
Absolutely. It's a totally different investment thesis now. And management's outlook reflected that gravity. Thomas Siebel, the founder and chairman, was remarkably blunt. He called the Q1 performance completely unacceptable.
He actually said that.
He did. He pointed fingers at two things. One, the disruptive effect of that big sales and services reorganization we discussed. And two, he mentioned his own unanticipated health issues, saying they kept him from being as involved in sales as usual. But, despite laying out the problems, he also expressed confidence in the new leadership and the restructuring plan. He believes the company is now positioned to accelerate going forward. And Stephen Hakian took over as the new CEO effective September 1st. So a clear changing of the guard.
That kind of candor is unusual, but it really highlights how serious things were. And that uncertainty is definitely reflected in their financial guidance, or lack thereof.
Exactly. For the next quarter, Q2 FY2026, they're guiding for revenue between $72 million and $80 million. The midpoint, $76 million, would be up slightly from Q1, which is, well, at least not another drop, but it would likely still be down year over year.
And for the full year?
They pulled it. Withdrawn completely. They cited the CEO transition and the ongoing restructuring. That action, pulling guidance, speaks volumes about the level of uncertainty right now. They're essentially saying, look, we need time to figure this out.
That's a huge signal. Okay, let's boil it all down. For you listening, what are the absolute must-know key takeaways from this C3 AI quarter?
All right, 4 key things to lock in. First, this was a hard reset quarter. A massive miss versus original plans blamed on internal chaos. The old growth story, it's gone. Invalidated, it's a reset, but from a tough spot. Second, profitability is under structure, under severe structural pressure. This wasn't just a sales problem. Collapsing gross margins plus soaring operating costs show a business model that was fundamentally broken at this revenue level. Fixing it needs more than just sales. It needs deep cost discipline.
Okay, reset and structural pressure. What else?
Third, it's all about the leadership transition now. New CEO, guidance pulled. This is your classic turnaround situation. The bet isn't on the old C3 AI, it's on whether this new team can fix it. And finally, fourth, that balance sheet is the lifeline. Amidst all the red ink and operational issues, that huge cash pile and no debt, that's their safety net. It buys them the crucial time and resources they need to even attempt this turnaround. Without it, things would look much bleaker.
That really crystallizes it. So, bringing it all together in the final narrative, this quarter wasn't just bad, it was a turning point for C3 AI, an abrupt end to the growth narrative, replaced by a daunting turnaround challenge. It seems like a perfect storm of internal issues. That sales reorganization backfired badly, costs ran out of control just as revenue tanked, and there was a leadership gap at a critical moment. Now they've hit reset. New CEO, new plan needed. The road ahead is purely about execution. Fix the sales engine, slash costs to match reality, stop burning cash. That big balance sheet gives them a fighting chance, but success hinges entirely on the new leadership's ability to stabilize things and prove this disastrous quarter can actually become a foundation for something sustainable, maybe even profitable down the line.
Well, we hope this deep dive has helped you get behind the headlines on C3 AI's Q1 earnings. Using a structured approach like this, really digging into the why behind the numbers, helps you build a much deeper understanding of any company over time. It helps you see the patterns, the pressures, and the potential paths forward. Now, just a couple of important disclaimers.
This report is for informational purposes only. It does not constitute financial, investment, legal, or tax advice. The information here isn't a recommendation or solicitation to buy, sell, or hold any securities. All investment decisions should always be based on your own research and in consultation with a qualified financial professional. While we strive for accuracy, we can't guarantee everything here is perfect. Also, this report was generated using an artificial intelligence model. It integrates data directly from C3 AI's official earnings release with public market data from real-time web searches. Although the AI follows strict data protocols, errors or omissions might still happen. So please independently verify all information, especially financial data and calculations, before making any decisions based on it. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.